How do subprime mortgages affect mortgage delinquency? Have you ever wondered how subprime mortgages influence mortgage delinquency rates? Let's break this down in a straightforward way. Subprime mortgages are loans given to borrowers with lower credit scores, typically below 600 to 670. These borrowers are seen as higher risk compared to those with stronger credit histories. Because of this risk, subprime loans usually come with higher interest rates, larger down payment requirements, and often adjustable rates that can increase over time. These factors make it harder for subprime borrowers to keep up with their monthly payments. When they face higher payments due to increased interest rates, the likelihood of falling behind on payments rises. This leads to higher mortgage delinquency rates, meaning more loans are late or in default. From the perspective of real estate investing, understanding how subprime mortgages affect delinquency rates is essential. Higher delinquency rates can lead to increased foreclosure rates. When more borrowers default on their loans, it can create a surge in distressed property sales. This situation can present opportunities for investors to buy properties at lower prices, but it also signals potential instability in the market. Additionally, areas with a high concentration of subprime loans may experience greater volatility in housing prices. When many subprime borrowers face difficulties, it can lead to price declines in those neighborhoods. This can reduce buyer confidence and further impact property values. Moreover, lenders and investors holding mortgage-backed securities that include subprime loans may feel the strain. Increased delinquency can affect credit availability and lending practices, making it harder for borrowers to secure loans in the future. For real estate investors, keeping an eye on the proportion of subprime mortgages in a market is important. A market with a high number of subprime loans may indicate elevated delinquency rates. This can signal increased risk for property values and rental demand. However, it can also help investors identify potential bargains in areas where foreclosures are more common due to subprime loan defaults. In summary, subprime mortgages lead to higher mortgage delinquency because borrowers often struggle with repayment due to their credit risk profile and the terms of their loans. This increased delinquency impacts real estate markets by raising foreclosure rates and market volatility. Understanding these dynamics is key for anyone looking to invest in real estate.